I want to talk about the Meta platforms a little bit this time because PE ratio of Meta has gone down to 13 times now. So do you believe it is a once in a lifetime opportunity for the investors, or do you believe it is a beginning of another value trap we have witnessed from Intel or IBM? Which side are you on?
Well, we own a little bit of Meta, and so I would put us on the positive side. I don't think this is a value trap. I think that I think the PE is misleading with Meta. I think it's actually higher than 11. I know mathematically it is there, but I think the earnings are probably going to come down when they report their June quarter and guide for September because of the slowness in the ad market. And so it's probably really trading right now at like 16 times, where the rest of big tech is, or 15 times, and the rest of big tech is trading at 18 times. So it's not an obvious pound the table. I think what is impressive to us, or what is encouraging to us, is two things. First is it's hard to build a network at scale, and they have caught almost 40% of the global internet population uses a Facebook Meta property on a daily basis, which is remarkable. It's hard to replicate. We think that TikTok eventually is going to get banned in the U.S., probably in the next year. There's rumors of that a couple years ago. We think that that will ultimately come to fruition. And last is, and most importantly, is Zuckerberg's commentary recently about cost savings, about he's never talked about expenses. He's never talked about tightening the belt. And now he's talking about that. And that's encouraging, especially given Sheryl Sandberg's moving on, and she's been the one who's typically been the one that's more cost conscious. What that means is that investors over the long haul should take some comfort that he's not going to spend outrageous amounts into the metaverse. And so earnings matters in these types of environments, and that's just encouraging.
I see. So a couple of things. First one is a competition side. TikTok's influence is getting smaller and smaller.
Well, I think it's strong now, but we think it's going to get blocked in the U.S.
Blocked. Okay. So totally gone then. And second of all, as you just mentioned, Meta was the company which never talked about cost control before, and then now
Zuckerberg did.
Yeah, Zuckerberg. They're trying to tight their cost expense, which means as a shareholder, we might expect some good earning result in the foreseeable future then.
Correct.
That's great. This time about Google, I read an article last weekend stating that Google had proposed splitting up its advertising tech business to appease government regulators. And to make it worse, the Department of Justice looked not very satisfied with the proposal, and they still want Google to sell some of its assets. So how big do you think is this investment risk related to regulatory problem? Should we consider it when we invest in Google?
Google and I think all big tech, I think Amazon and Apple, I was surprised to read the story that Google was essentially giving in and trying to find ways to work more closely with regulators. I thought that they would fight this to the very end. It sounds like they're fighting it now again, but I think it speaks to the intensity level that these companies have had. If you're going to say which companies are most negatively impacted, when they were on Capitol Hill, when these big tech companies a year ago were spending time on Capitol Hill, we had always ranked it as Google and Facebook are kind of at the most risk, and then Amazon, then Apple. And I think that's true. Those are dynamics that are still true. I suspect that we have one analog to look at is what happened with Microsoft. And when there was talk of breakup, and they did make some changes ultimately, it caused the stock to there was some negativity around it for a long time. With Microsoft, I think there was a bigger issue around innovation that they had. It was less about the breakup. that does create some headwinds. We like Google. We own a little bit of Google. I think I would just say this is that's the wild card. That's the piece that makes me a little bit uncomfortable. It doesn't change my broader view that they're going to be in a good place longer term, even if they divest some of these. But that is something that we just don't have a good view of what impact it's going to be.
I see. For the beginner investors, they are always worried what would happen to my shares when a company split up. What is the usual case? What happened to my stock?
Yeah, usually what would happen is you'd get what's referred to as a stock dividend. So they would have some calculation for every share of Google that you own, you would get a fractional share in the new company, Newco. So I don't know what that ratio would be, but just as a hypothetical example, is that for every share you might get 0.2 shares in this new company, and so if they split it out, essentially you would have two stocks that would be trading on their own merits. It's the most complicated piece around it is related to just creating structure around. Essentially, you have to take a business that is now part of a big organization and make it a standalone. They have their own leadership right now, even inside these big organizations, but there's compliance and there's a lot of legwork around that. So, but that's basically what happens is you get a stock dividend.
I see. So let's say in case Amazon is splitting up with the e-commerce and AWS, maybe we will own two different company stocks then, according to the percentage. So theoretically, there's no damage then.
In theory, you can build a theory that there's no damage, and that's the most likely theory. There's a theory that there's unlocked value, that by splitting these up, it allows businesses that have not had higher multiples to be re-rated higher. Usually that doesn't happen. It's usually a wash. And then you have a theory that part of the business becomes just kind of forgotten by investors. So, but in general, I would think of it as a neutral. It should be a neutral.
I see. Thank you for the your opinion. Last time we did not talk about any semiconductor companies. For your information, Korean investors love semiconductor companies. I think a part of the reason is because we have Samsung in Korea. What are your favorite semiconductor stocks in US at this point, and what would be the reason you like them?
So we're investors in Intel. I thought just from so we like Intel. We like it based on onshoring. I think just maybe from a highest level regarding semis is that what happened with Micron, even though that's not semiconductor, it's kind of memory and storage related, I think was really encouraging. They guided down for on an August quarter is their next quarter. They just reported their what it would be an April quarter. They got it down by 20%, and the stock closed down that day by 3%. That's encouraging when you see that dynamic. So I think that from a high level, I think that some of the negativity is getting priced into some of these chip makers. From our view, what's appealing about Intel is that there is this, I think, onshoring dynamic. I think what we've seen in Eastern Europe, we might have talked about this last time, it probably was too fresh, but around what's happening with oil, I think sets a precedent to what could happen in the semiconductor space, specifically around TSMC and what's manufactured in Taiwan. And of course, this strategic ambiguity that Taiwan operates under has been a wonderful balance over the last 40 years, but that probably doesn't last forever. And more importantly is that I think you're going to see the U.S. and some Western companies not wait around for something to happen. I think that there's going to be a really sense of being proactive, especially around advanced semiconductors. And that, of course, leads to some of the U.S. Congress giving money to Intel to invest in chip production in the U.S. Now that hasn't been approved yet, but it likely will be approved, and it's going to take a few years for that campus to be built. But I just think in general, you're going to see this dynamic in chips around onshoring, and that's why we own Intel. TSMC has factories in the U.S. too, but I think you're going to see greater investment from U.S. and Western Europe in their own technology infrastructure, because from an economic and security perspective, they just can't be beholden to Taiwan.
I see. Actually, this onshoring trend was initiated by COVID virus, right? So, in your
Yes.
opinion, they will continue to dominate the semiconductor market.
Another company that we're optimistic about, it's a private company, it's called Redwood Materials, but they also kind of benefit from some of government aid and essentially building the battery supply chain in Western Europe or the US.
Next one, I want to move on to cloud SaaS company, because I hardly see you talking about SaaS companies before. Is there any SaaS company stocks, in your opinion, which might have a bright future?
Well, the one that we consider a SaaS that we do own is Zoom. And I think that, it trades at right now about a 6.5 times multiple, which is kind of essentially the new revenue multiple on next year's revenue. That's kind of the new SaaS multiple. It used to be 10, 12 times a few months ago. So it's not like it sticks out as an obvious company to own based on valuation. But we do think that when you go from working remote 5 days to 1 day, you still maintain your Zoom subscription, and there's still just a lot of value in it. And we suspect that they have pricing leverage. And so that's really the extent of our focus on SaaS right now is related to Zoom. There's another company we're not invested in, Peloton. There's a case that you could argue this is kind of a software content type of company. They have a big hardware business that's pretty controversial that they're losing money on right now. But that's one that trades at like 1 times their subscription revenue. But there's a lot that still needs to play out there.
Sure. Excellent. What about the FANG companies? Among FANG companies, which stock would you buy at the moment if you are a trader with a short-term perspective?
Well, I think that all these companies are going to be under pressure for this earnings period. I think it's going to be a messy commentary around September. And so I think that if you're looking for a 2-week trade, a 3-week trade, I think that my sense is just to stay away. This is not investment advice. I think if you look at a view of into 2023, there's more reason to be optimistic. And which companies do I think you can own? We talked about Apple's a great one. I think Amazon's another company which we're going to start to see in 2023 some positive earnings revisions. They've made some healthy investments, hefty investments in infrastructure. They invested $60 billion last year in infrastructure. That compares to Microsoft at, I think it was 20 billion, and Google at 12 billion. So they have they've really they overbuilt essentially. And Jesse has talked about this, but that would be another company that I would kind of flag. And I think the unique part about Amazon is that what they have cannot be replicated. Meta, what they have something that's unique around global directory, this connection of almost 40% of the daily internet users. But some things can, at a low cost, can come and compete. TikTok's a great example. You just don't have that when it comes to Amazon. Trying to build an infrastructure around delivery and the top of the funnel that they have with their retail business is just, it's really difficult, almost impossible. Imagine going to all these different municipalities and cities and trying to provision for these new warehouses and to do the hiring around this infrastructure. I think it's something that it's not very techy, but it is a massive competitive advantage that Amazon has. And so that's the other one I would flag. And the last one kind of that still orbits around there is Netflix. And we still have some apprehensions about Netflix.
Excellent. Thank you. I think it will be the last question now. Since 2020, a lot of new Korean investors have entered the U.S. stock market with a big hope that U.S. stock market should be able to continue its steady performance for the foreseeable future. Because looking back the history, the people investing in the U.S. stock market have been able to enjoy a very healthy return, let's say almost 10% on average. Do you believe this success story can continue for next 5-10 years, or it'll be a different from now on?
When it comes to tech, it's not investment advice, and my belief is that this can continue in tech. I think that the expectations, it's all about growth, like we talked about in tech. And I think that U.S. tech companies still do a great job of innovating. And I think that the investors recognize that, because I think that the growth is going to continue to be healthy. Mm-hmm. And some of them can be the big tech companies. Some of them, it could be Tesla. I think there are smaller companies that are powering that too. So I think when you put all this together, I would put it in the context that we're not going to get a big bounce back like we saw in March of 2020. Unfortunately, those expectations should be removed. But I think if you look at this in the context of 5 or 10 years, especially in the context of tech, I think that the U.S. market's a great place to be. I'm biased. I've spent my career in this, and so, but I just believe in innovation, and I believe that a lot of these companies are continuing to lead the way, and I think the stocks will respond appropriately.
Excellent. Hopefully, your the outlook will follow in the future. Let's call it a day, Jin. Thank you so much for sparing your precious time and wonderful insights with us. I really appreciate it.
Thank you for the time.
Thank you. Yeah, have a wonderful day ahead.
Thanks. Bye-bye.
Thank you. Bye-bye.